Let's dive deeper into ias1 by focusing on two core questions. Who does ias1 apply to and what exactly is it trying to achieve? We'll also look at the underlying assumptions that sit quietly behind every IFRS financial statement. And trust me, they're more important than they look. By the end of this chapter, you'll understand why ias1 sets the tone for the rest of IFRS and how it ensures that financial statements tell a clear and reliable story. Here's what we're aiming to cover. We'll start with the scope. Which entities have to apply ias1? Then we'll look at the objective of the standard, not just the rules, but the purpose behind them. And finally, we'll cover some core assumptions and presentation principles that shape everything we do when preparing IFRS compliant financial statements. ias1 applies to all general purpose financial statements prepared under full IFRS. Okay, that means it applies to consolidated financial statements, separate or individual financial statements, public companies, private companies, as long as they apply IFRS, but there's one key exception. Interim financial reports, like quarterly updates, are covered under IAS 34, not IAS1. So in short, if you're doing a full set of annual financials under IFRS, IAS1 tells you how to present them. Now let's talk about an objective. IAS1 wants to ensure that financial statements give a true and fair view of the company's financial position and performance. But it doesn't stop there. The statements also need to be comparable and across time and entities, consistent and from year to year, and above all, understandable and for users. So the focus here is really on reliable, structured communication. IAS1 doesn't just organize the data, it builds trust in the data. Behind every financial statement under IFRS are two quiet giants, going concern and accrual basis of accounting. They're not flashy, but they are absolutely fundamental. If one of them breaks, the entire financial reporting structure starts to shake. Let's take a closer look at each of them, because you'll see them referenced not just in IAS1, but across the IFRS universe. This one is simple, but powerful. When we prepare financial statements, we assume the company will continue operating into the foreseeable future. That's the going concern assumption. But what if it won't? Then management has to disclose that and possibly use different measurement bases like liquidation values instead of cost or fair value. This assumption affects how we value everything and whether users can trust the entity is stable. That's why going concern must be reassessed at every reporting date. Accrual accounting is the beating heart of IFRS. It means we record income and expenses when they are incurred, not when cash actually changes hands. Why? Because that gives users a true picture of performance, not just of cash flow, but of economic reality. It's what allows us to match revenue with the costs that earned it. That's why the only statement still based on actual cash, the cash flow statement. Everything else uses accrual accounting. Here's a principle that seems obvious, but is often violated in practice. IAS1 says we need to use the same presentation and classification every year. That's how users can compare one year to the next. You're allowed to change the presentation only if a new IFRS standard requires it or the new format improves clarity and usefulness. Otherwise, stick with it, because consistency builds comparability and comparability builds confidence.